This episode of The Matt Ferret Show is brought to you by the Brickhouse Agency. Brickhouse is a boutique independent health insurance agency that focuses on finding the right Medicare coverage for folks across the country. Matt's wife, Nikki, is the heart behind Brickhouse. She's great at making confusing things clear and is passionate about helping people find a Medicare insurance policy that suits their individual needs. To schedule a free one-on-one appointment with Nikki or a member of her team, head on over to brickhouseagency.com or simply call 844-844-6565 and someone will help you schedule a phone call or a Zoom meeting. The consultation is free because the insurance companies pay Brickhouse, not you. There's never any pressure or obligation to enroll. Your clearer, simpler Medicare journey is just a call or click away. brickhouseagency.com. Not affiliated with or endorsed by the government or federal Medicare program. Contacting Brickhouse Agency, LLC will direct you to a licensed insurance agent.
Welcome to the Matt Ferret Show. Practical conversations to help you thrive in midlife, retirement, and beyond. I'm Matt Ferret, author of books and courses on Medicare and Social Security, and a former healthcare executive with decades of insider experience. I use that experience to help people make clearer, smarter decisions about health, wealth, lifestyle, and caregiving. Each week, I sit down with experts, insiders, and fascinating people to explore what it really takes to thrive, finding purpose, building stronger relationships, and creating a sense of meaning and community in the second half of life. Together, we'll light the path towards your wealth, wisdom, and wellness. Welcome to the conversation.
Today's guest is here to flip the script on how business owners think about retirement plans. He's a 401k expert who teaches entrepreneurs how to use their 401k not just as a benefit for their employees, but as a powerful tool to cut taxes, increase cash flow, and build long-term wealth. He's been featured on dozens of podcasts, hosts his own, co-hosts it, the 401k podcast, and helps business owners all over the country turn their retirement plan stack into one of the most valuable assets in their business. You can find him online at 401k.expert. Matt Rutenberg, welcome to the show.
Thank you, Matt. I really appreciate you having me on. Thank you so much.
Sure. Happy to have you. So let's start here. Tell everybody what you do, how long you've been doing this, and how you got into helping business owners rethink their 401ks.
Yeah. So I'm co-owner of basically a 401k administration company. We've been doing this for over 20 years in the finance industry in general. I'm a third generation financial expert. Part of those last 20 years, I actually did financial advising, financial planning, where I was more of a generalist. I wanted to really focus in on being a specialist and working purely with business owners. I find it to be fascinating. Every single person is completely different. Every entrepreneur journey is completely different. And I could just sit here and talk business with anybody for hours and hours and hours. So becoming that specialist allowed me to sit on the same side of the table as everybody, with your CPA, with your financial advisor, or just directly with you as a client. It allows me to be a part of the team. And that's really what I wanted to be. I wanted to connect people and work as a team. And that makes you a more powerful business owner at the same time.
It makes sense. So you dabbled in, maybe dabble's not the right word, but you were a financial advisor, but found your niche and I guess, to use the P word, your passion in this particular piece. So talk to me about, I think we all know what financial advisors do, but you specialize, you call yourself a 401k expert. What's the difference and why is that difference important?
Yeah, so I look at financial advisors and financial planners. They're the quarterback a lot of the time. Even the CPA, even because that can be more of the quarterback or the generalist, the general practitioner, if you want to look at it from like a medical standpoint. They're the ones who diagnose things and say, hey, this is an issue. We need to pick apart this and put your overall plan together. But then when you bring in the specialist, it's to take care of a very specific situation or need that the client has. So we're definitely not financial planners. We don't look at the full picture 90% of the time. We are the ones who are saying, let's max this goal out, this very specific goal, which a lot of times is taxes, which you brought up earlier, and allows us to work hand in hand with the financial advisor or the CPA or tax strategist or whoever that may be. And that's a very big difference there. We have a very narrow scope of what we're looking at.
Yeah, so it's not necessarily well, when people think entrepreneurs, right, they think, and 401ks, they think bigger companies.
Mm-hmm.
But that's not necessarily true, is it? Because there are, everyone, if you go to work, you get a W-2, you get an employer that has a 401k, you use it. But for someone doing not only an entrepreneur in the truest sense, which is I started my own business and I have a 401k, but also what about the solopreneurs out there? The people that are making, I don't know, 30 grand, 40 grand, 50 grand, 60 grand doing a photography business or doing dog walking, or maybe they have a couple of rental properties. Help me reshift or rethink about what, 401ks mean to the individual, and entrepreneurship doesn't just mean someone that owns a company with 150 employees.
Business owners have a huge advantage in terms of what's available to them and for tools like tax tools, right? And so if you're a solopreneur or you're an independent contractor, or you have a side hustle because you want to mow grass on the weekends, but you have your day job and you have your W-2, you have something available, which is the 401k, because you are self-employed, right? So a lot of people think that $23,500 is the maximum you can put into a 401k. And the reality is once you're a business owner, you have this self-employed income. You don't need an entity. You just need to have self-employed income. So that's like Schedule C, be a 1099 contractor. As long as you're showing that income, you can unlock this 401k. But once you do that, now we're talking $70,000 of contributions you can put into a 401k. And even on top of that, which we'll talk about later, is 300 grand up to, multiple 6-digit contributions that you can get into these things. So just having that self-employed income unlocks all these different things. And again, there's 7,000 pages of the IRS code. This is one code, 401k, and it's maximizing that tax code to your benefit. Like you mentioned, when you work for a day job and you think of 401k, it's an employee benefit. In reality, it's a tax strategy. It just has to be looked at it that way. And when you do that, it just unfolds more opportunity to help scale your business, or to, buy more franchises, or whatever it is, buy real estate, things like that. It's just knowing how to do that and finding the tools to do it that way.
So you mentioned taxes, so did I, a lot. So most business owners, are they appropriately using, and I'll frame business owners as big ones, medium ones, small ones, or even solopreneurs, that most business owners are overpaying in taxes and don't even realizing it. True or untrue? And if true, why is that happening so often?
So one of the biggest misconceptions is, this is what I'm trying to push out here, is all 401ks are created equal, right? So you can go here, you can go here, you can go here, and it's 401k. It's check. I got that. CPAs, tax accounts, a lot of them think that all 401ks are created equal, and your contribution is this. You can invest in this and call it a day. And the reality is there's different kinds. It all comes down to the legal plan document that is created for that plan. And it's called an adoption agreement. And you can build one where it's like a boilerplate. You go to LegalZoom, download your legal document and plug in your name and address, and boom, you have a legal document. Or you could hire the attorney who creates it a little bit more custom and designs it and tweaks. There's so much gray area to that adoption agreement, more than anyone can ever think of, because what happens is you can either be plugged into this one large plan document that everyone else uses and that's it, or you can customize it to what you're doing. Now, when you do the boilerplate, there's not a lot of things you can do because you're stuck to these rules. But again, the gray area allows you to really focus in. And when we come down to this plan design, we ask 2 questions. First question, it's kind of multiple choice, to be honest with you. It's, why are you talking to us? What's the priority? Why are you creating this plan? Is it you? Is it for your employees? Is it taxes? Is it all the above? And a lot of times people are saying it's for my employees because, they're asking for it. My state, there's a lot of state mandates going on right now. Like, you have to have it. And the reality is, we move on to section 2 of that question is, how much do you want to save? How much can you earmark towards this? If this is for taxes, how much are you hurting? Are you hurting a lot with these taxes? Do you have a 5? Do you have a 6-digit tax bill? And then how do we design and create that retirement plan stack around what your goals are, not what all the other businesses out there are?
Okay. Can you break that down in terms of like 3 different audiences? So one is the small business owner, and I say small, let's go from 2 to 99 employees. Then the second one is someone who has it's more than a side hustle. Let's call it I don't know, maybe a spouse runs a business, and the other side of the spouse is working at a W-2 job with a 401k, and that business can be, I don't know, let's call it 5 people, 10 people. And then you've got the solopreneur, which is, maybe it's a side hustle, maybe it's a dog walking business, or maybe it's just a consulting gig that they have 1099. How should people think about it from a tax standpoint in those 3 scenarios? I know that's a tough question, but I'm just trying to break it down into 3 different groups of people.
So let's start with the solopreneur, because that's pretty common. We get a lot of phone calls on that one, a lot of emails, and it's quite simple, right? It's that first question kind of goes out the door. We now know this is for you as the business owner because you don't have employees to worry about. Right. So the annual testing is a lot more simple. It's all about how much do you want to save into this. We also know it's most likely going to be a tax play. Realistically, it's going to be a tax play. So you as a solo entrepreneur, you're going to create this solo 401k. And the solo 401k is broken down into 2. All 401ks are broken down to 2 different types of contribution. You as an employee of your own company, and then you as an employer of your own company. The first portion is what comes out of your paycheck, right? Your deferrals, and that's $23,500 is what you can put into that portion. And then the second portion is get you up to that $70,000. That's profit sharing, also known as employer contribution. If you have employees, the match goes in that category too. But so when I go back and say, hey, how much do you want to save? That tells me which category to put that in, which one to focus on. And then it comes down, how are you paying yourself? Are you an S corporation? So there's a lot of variables to that equation, but it actually becomes quite simple. It really comes down to how much you want to save or how much you want to save in taxes. That's it.
So if I understand that correctly, then, so if I'm a solopreneur and I get my little gig going and I make $70,000 in a calendar year, hypothetically, if I have a solo 401k, I could put $70,000 into that 401k and show 0 income.
So the way that calculates, right? So that's a perfect scenario because 70,000, it's called the 415 limit. It's a tax code, 415. So the way this works is, let's break those 2. The first 23,500 as an employee of your own company, you can put all of it in there. Okay, 23,500. Then the difference is the profit sharing. You can do 25% of that 70 stacked on top of that. So you have the 23,500, and then 25% of 70 is 17,500. So we're looking at 41. Is that 41,000? That's what you could put into it.
Okay.
Now you've probably heard of a SEP IRA, right?
Yes.
Or SEP IRA. A SEP IRA is the IRA version of profit sharing. Okay, your max is 25% of what your take home is, right? So 70, that's the 17,500. But what the difference of that solo is that first 23,500. You just were able to more than double your contributions with the exact same income because you used the solo versus the SEP. So if I asked you that question, how much do you want to contribute, and you say 15, I might say, okay, just do a SEP. It's easier. Less administration. You don't have to worry about a lot. It's just simple plug and play is a SEP. But once you start going above that 17,500 assuming you're making $70,000, we're going to start looking at the solo 401k.
Okay. So for then the mid-sized or small, maybe
Mhm.
you've got a retail store with 5 employees or 10
Yes.
or that type of thing. What does that look like?
Yeah. So that one, that goes across the spectrum. And it's really, really important to understand what that first question is. It's what is the goal? Because that could be someone who just getting started and their employees are saying, hey, I'd really like to start my 401k contributions, or the state mandate is saying, hey, you have over 5 employees, you got to insert some sort of retirement plan. So understanding what the purpose is and understanding what do they want to do for their own bucket of money as the owner is really important, because realistically, this is more of an employee benefit for a big chunk of the country and the business owners. And they're not really stockpiling for themselves yet because they're reinvesting in their own business. If they're reinvesting in their own business, we're going to go down one path of building out this design, where we're not really focused on the employer, we're focused on the employees. So there's not too much tax play going on there because maybe they're writing off a lot, they're reinvesting into the business, so there's not a ton of profit there. So we're not really worried too much about that. It's when they answer the question, this is for me. Believe it or not, we get a ton of clients who reach out to us after 40 years old. They've had their head down for a decade or two, and all of a sudden look up and they have this profit, and their CPA is like, hey, we got to do something. And creating a 401k is in the top 5 things that the CPA says you got to do this now. Like create an S corporation, hire your kids, open a 401k. That's one of them there, right? So that tends to be something there where let's say, okay, let's start knocking this off. Sometimes you start with the 23.5, and then as you start growing and becoming more profitable, you start adding profit sharing, and then you can add defined benefit plan on top of that.
Okay. And then what about the larger sized folks that are out there?
So when you say larger, are you talking about like 25, 50 employees?
Sure.
Or
Yeah.
profit levels?
Let's go 25 plus. Like you're legit a quote unquote small business, even though 25 to me is not small at all. But yeah, you're legitimate small business.
Big. You've got, you wearing a lot of hats at that point. And hopefully you've hired some help on that. And that one is really, really important. The design work on this company is super important. Because, and I can't tell you how many I've seen that have been misdesigned to where efficiency rating is key. Efficiency. Because taxes are a big part of this equation, and most likely the business owner is starting to stockpile into their own bucket of retirement. Efficiency rating is how much does the owner get to keep versus the employees. How much do you have to give to the employees in order? So the 401k tax code is built for the business owner. I know it's like, and it's an employee benefit, but the way it works out is as long as you take care of your employees to a certain degree, you can take advantage of the rest of it. So for example, let's say 25 employees. And again, this can go all the way from I'm still in growth mode, I'm just buying franchises, I'm doing all these, whatever it is, I'm expanding, to let's say a physicians group who there's 4 owners and 25 employees. Some of them are staff, some of them are nurse practitioners and things like that, and they're making millions. Okay. So efficiency rating is very important. And we're going to dive into this here in a little bit as you build out this retirement stack, right? So 401k, profit sharing, defined benefit, and you can get it to a point where, I'm just going to tell you right now, we've had a client who we were able to get $2 or $3 million into the plan every year, and they're giving 10% of that to the employees. That's a 90% efficiency rating, right? So we're taking care of the employees to a certain degree, and then you can take care of the rest of that for the business owner, and it becomes a massive, massive tax play.
Wow. Yeah, you mentioned it, so I'm going to ask you the retirement plan stack. What's in that? How does that work?
So we have kind of coined this phrase retirement plan stack because it gives you a visual of what the heck, the 401k retirement plan world is vast. There's so many. You've got simple IRAs, SEP IRAs, 401ks, profit sharing, defined benefits, split funded deposit. There's so many options. And basically what this is an upside down 3-tiered wedding cake. Okay. Could be 4, it could be 5 layers, but.
Yep. Got the visual.
Down, right? So the bottom layer is the 401k, which is now the smallest, right? Traditionally, we're trained to think 401k is a pretty big size contribution, but in this stack, it's the beginning. And then you have the profit sharing on top of that. And then you have defined benefit. And then you can do executive benefits because, maybe if you have a doctor's group, for example, you have mission critical, 5 employees you want to take care of because maybe they're your successors or if they left, you'd have a really big task to replace them. And
Right.
that's, you focus on those individuals. But as you grow and profit and as your needs change, you start adding these layers. And every layer is designed a very specific way to maximize the layer above it. And if it's not done in a very intricate way, and if you're doing boilerplate versus custom, for example, you might be giving too much money to your employees where that's honorable. That's great. If that's your goal, fantastic. You want to, if you're a millionaire, you want to create millionaires around you, right? You want to help them. But if your goal is to saying, I pay them very well, we're commission-based or something like that, I've created this baby, now I need to take advantage of it. Take advantage of what I've built and make sure that I can grow even further. And when you do that, you could accidentally be giving away 5 digits of employee contributions that you didn't have to. And I've seen that. Absolutely, I've seen that. So the stack and the way it's built is very, very important. There's certain layers that we add. There's gateways to get to the next level and doing it a certain way. And it's very, very important to build it that way. But the retirement plan stack is something that we really hone in on and making sure that everything is done properly and through compliance and making sure the fairness rules, which is the annual testing, is taken care of.
So that upside down cake, tell me each layer one more time.
Sure. So you have the 401k. All right. Yep. So that's the 23.5. That's the deferrals that come out of your paycheck, right?
Yep.
Then you have your profit sharing contributions that can get you up to 70,000. Yep. And these are 2025 numbers. So if we're
that's fine.
Anyone listening to this next year, it actually went up a little bit. But then you go up to the defined benefit plan. A defined benefit plan is also known as a pension, right? So the old Ford and GM pension plans that we all know and love, right? That they ended up buying everyone out back in the day. There's more casual versions of that. I call them cash balance plans, but defined benefit plan is where you can get up into, I've seen $350,000 per year when you add all 3 of those layers. Okay. Then you hire a spouse. Now we're talking 600,000. There's a lot you can do with that. And then the 4th layer is rare, but those are generally for larger companies when you have those mission critical and you can just focus on one person. And that's who you want to focus, like a CFO, C-suite, that kind of thing. Those tend to be larger organizations. But, and then inside that defined benefit plan, there's a lot of neat things you can do with that. So if you are creating this wealth and you have this multi-generational goal, you want to take care of your kids, your grandkids, you can do something called a split funded defined benefit plan, where you can actually buy life insurance inside of that defined benefit plan, pre-tax, and give it to your heirs tax-free. There's a lot of strategy in there. That's where the strategies come in, and you start, who's in my team? I got to have an attorney. I got to have my CPA, make sure all this stuff comes together. And that's where you get really, really powerful tools inside of that once you start adding these layers on top.
Wow. I didn't know those numbers were possible. I mean, I'd heard about the solo 401ks, right?
Yeah.
And then of course we know 401ks in the small business setting, but the above that gets into real, quote unquote, real income and real profitable. You mentioned doctors groups, right? That's a great example of that. Yes. in those, if I'm thinking about this, listening or watching, what type of income do I need, or does my company need to make at those different 4 levels to even kind of think about these sort of things?
Yeah. So when you're doing first level, you're in growth mode for the most part, and you're trying to diversify and, start early, start saving early. So compound interest is really, really important. So your, profit is generally minimal, to the point where the goal is to get your profit down to 0. Right. And that's why you're starting to add your taxes down to 0. That's where that 401k level comes into play in less. You can even show a loss and still do those. But The profit sharing is when you're starting to get into the, I got 150,000 profit, I got a $200,000 profit, because, you're looking at you yourself can do up to 70, and then you have to, if you have employees, you might have to give them some, in order, again, the goal is to get most of those dollars in the owner's pocket. A lot of times the CPA will come to us and say, hey, we got to get 100 grand off the books. What do we do? How do we get most of that to the employer? And that's what we do. We run the numbers. We keep it open-ended and focus. There's all sorts of different ways to calculate that. But then when you're getting into like maybe, a lot of this has to do with like personal budget too, right? Like how much do you need out of these distributions and dividends? But 500,000 is a good number to look at. Once you start hitting that, you can start implementing that third layer. Once you start getting above that, then you start doing the defined benefit plan, split funded defined benefit plans, and adding insurance stuff into it. And then above $1 million is when you start bringing in other strategies. Again, this is one code, like charitable, family foundations and things like that. So there's so many different tools that the business owner has. And it's tax strategy is what this is. And this is one tool, one piece of the overall pie that you need to look at.
So I'm going to guess that most financial planners and many CPAs don't know this stuff. So what's your advice for people to ask questions of either or both?
Yeah.
To start digging into this, is this for someone who is starting? Is this for someone who's already established? What are the right ways to go about thinking? You said start early, but that start early is not just in the contributions, but it's start early in the planning. So how do you ask questions of your CPA or the person who does your taxes if it's not, if it's just, one of the desks at the big box store? What do you ask? How do you know that these folks are thinking about these things?
Great question. Great question. So I'm going to take this into a couple of different parts here. So most advisors and most CPAs don't know this stuff, right? This is a pretty advanced stuff, but and it's not, but at the same time, it's not their job, right? It's there to understand what is there and then go find that specialist, right? So to identify, yes, but there's a huge misconception in the accounting industry or towards the accounting industry. And everyone thinks I have an accountant or a CPA. It's their job to just fling these strategies at me. Hire my kid, the Augusta rule. Do I, rent out my house for 2 weeks so I get that tax free? What do I do? That is not their job. Their job is to do the accounting, crunch the numbers with what you've given them, and do the deductions and things like that. Then you have tax strategists, which can come in multiple forms. Some of them are CPAs, some of them are tax attorneys, some of them are me, some of them are insurance agents, some of them are financial. There's multiple things, and there's so many tools. I could share all sorts of strategies with you that would blow your mind. But investing in Hollywood films give you a 4-to-1 deduction. Who does that? Right? Who tells you that one? So it's having all these people together and questioning, saying, hey, what else can I do? You kind of have to do your own research, unfortunately, and then you bring those things to the accountant that you're working with, and then they'll say this works for you or this doesn't work for you. Tax planning is completely different than accounting. If you're paying a few $1,000s a year for your accountant, that's not planning. You can expect a much higher bill because there's time involved in that and looking everything over. Accountants are transactional for the most part. They might have some strategies in their tool belt, but for the most part, they're not. And when it comes to like, how do you know who's doing what? Let's go back to the boilerplate versus custom approach, right? Everybody is, in my opinion, could do the custom model, which is what we offer. Boilerplate, I think, is okay if you're being forced to do a 401k. Okay, so what I mean by that is your state, there's 43 states out there that have something planned or something coming for a state mandate, meaning you have 5 employees or more, you have to have something. There's always a state version, which is the bag of IRAs, and it's free, and it's not really great investing. And you say, yeah, fine, check, whatever. There's a 401k version of that. There's a lot of like we call them the robo 401ks or the turnkey, like plug and play. Customer service is an email, not a person. That kind of thing, and they're
Yeah.
very cheap. And it's like, yeah, my employees came to me and said, I need something better than this bag of IRAs that the state is offering. I want some better investments. Let's do the 401k. And they're like, fine, let's do that. Cheap, turnkey, let's go. But if you want to have it really customized to yourself, then you can start at any level, really any level. And then being able to mold that to your business, eligibility requirements, vesting, all these different things, why you might want to use this safe harbor 401k versus this one instead of just throwing it out there. Many, many reasons why a custom model is good for everybody. And a lot of people are going to be like, hey, custom sounds expensive, right? There are a ton of tax credits going on right now for 401k plans. The Secure 2.0 Act what was that? I think January 1st, 2023, maybe. Let's go with that. So there is, you're going to get $250 per person in your 401k as a tax credit to pay for your out-of-pocket expenses. Okay. If you have, and then for every participant who earns under 100,000 is going to get $1,000 per person to offset the match that you give them. So if you have 10 employees, you're going to get probably $13,000 in tax credits, not deductions, credits on top of the deductions that you're getting. So that pays for a lot. So it's to really, really push what, people need to start saving for themselves for retirement. I think it's like Social Security, what's going on there. So that's why they're pushing it.
So, you just mentioned a recent change, a couple of years old. These things have been around for, when did they start? 80s, early 80s, 401s?
Yeah. Let's go with the 80s. Yes.
Yeah, I think early 80s, somewhere in there.
Yeah.
And is the 401k or traditional 401k model, in your opinion, outdated?
The current model of 401ks is, I would call it turnkey, packaged, if you will, right? It's like a nice clean package that somebody can go out and collect, and it's got your 25 mutual funds sitting in there, and you got your default target date funds, and it's basic, I guess you could say. It's a nice package. There's online tools for the employees and things like that. That is probably what everyone assumes. Like the amount of people who call and say, a business owner, right? They had a state mandate. They said, I need to do a 401k. I don't want the bag of IRAs that the state is offering. This is in Illinois. And I'm like, okay, well, what do you want to do? I don't want to do anything because I don't like traditional investments. Okay. And I said, totally get it. I also don't like traditional investments myself, to a certain degree. And, but sometimes it's good to have that there in case your employees need that as a backup. So beyond that, you're not stuck to it. You're not stuck to just those basic mutual funds, which is, like you mentioned, the current model of how 401ks look.
So let's move into that then. Beyond stocks, which I think is what you were alluding to.
Yes.
Everybody knows the model. Yeah.
Yeah.
Age funds, and 2065 is a 90-10, 2060 is an 85-15, and so on and so forth.
Yes.
And then you've got your, US and your international. You get a little basket of funds. You go clicky a couple times a year if you rebalance, and then you're done. But talk to me about using 401ks for real assets and what that means.
So there's a term called self-directed, right? Self-directed 401k. A lot of them are self-directed IRAs, the term that most people, I think, are interested in. It's because real estate investing is become extremely popular in the last, 10 years. It's become, social media has built it up quite a bit, right?
HGTV,
it's been around forever.
20 years. Everybody thinks they can roll into a house and flip it for millions. Yeah.
Exactly. Yeah. So, that's just one thing. You can invest in basically anything inside of your 401k, except for just a handful of things like art. You can't go buy art. and put it in your 401k. But you can do cryptocurrency. You can do real estate. You can act as a private lender. You can get into, private debt. You can do a list of an almost unlimited list of things you can do. You just have to abide by those rules in order to do it. So you can invest in a duplex. You can flip a house. And what you're doing is you're adopting the 401k tax code around that investment. So what I mean by that is, let's say a lot of people don't want to do house flipping, especially these days, but they don't want to do it because short-term capital gains can get up there, right? So if you're buying and selling your property within a year, not that it takes that long anymore, but if you do that, you're going to have short-term capital gains. And if you do it inside of your 401k, you don't pay capital gains. It's deferred income tax, just like if you put it in mutual funds. Same thing. If you do it inside of the Roth, it's all tax-free eventually, right? This is a polarizing topic with real estate inside of your self-directed 401k. It's because there's a lot of tax advantages outside of the 401k too, right? You get your depreciation, you get your advanced depreciation, which is, cost segregation studies where you can advance all that tax deductions, or depreciation in the first year now, right? And it ends up being a massive tax strategy. So, but at the end of the day, tax-free is pretty good inside of a Roth. Inside of the Roth portion of your 401k. A lot of people don't realize 401k has Roth too. Just throwing that out there. You have a Roth option. You should have a Roth option. Sometimes the more simple boilerplate versions don't, because they're trying to keep it their process is very tight. They don't want to have their employees think outside the box, say, oh, we got all these different things. We got to do a Roth conversion and all these different things. No, you can do that. And it's all about staying organized, which, we have software that tracks all this stuff, where you can go put all your money into your 401k. You can throw some of it at, the cryptocurrency custodian. You can buy real estate with it. You can send it over to Fidelity and buy individual stocks and bonds. You can do all that. The 401k is an umbrella. Okay. And inside of it, you can have as many custodians as you want. You just can't have more than one umbrella.
Got it.
So it's got to be organized.
So all right. So I can buy crypto. I can buy real estate. I can't buy art. All right. So let's just say that I'm an employee, and I'm a loyal employee, and I have $1 million value in my work 401k.
Mm-hmm.
Can I do anything with that?
So if you're working at a day job,
yeah,
and you want to go into all these things, it's all about what the owner of the company has designed for you. Okay. So, it's very difficult to stay, compliant when you have a bunch of employees too, right? To have the employees say, I want to go buy a duplex inside my 401k as an employee, almost impossible. It's going to be very, very difficult.
Okay.
These tend to be more in the solo side of things, because you don't have to worry about your employees going out and buying real estate and making sure they're compliant, and it'll blow up the whole plan. There's a lot of rules around using, you cannot live in a property if you buy inside your portfolio. You don't touch that with a 10-foot. Every little utility bill, every time you hire a handyman or whatever it is, needs to come from the assets of the 401k. You can't start pulling out your debit card from your bank account and paying for the water bill in your self-directed duplex that you own. Everything has to come from the cash in the 401k. So when you have employees, you don't want to open that Pandora's box, if you will, to allow all that. But what you can do is allow them to do something called a brokerage sleeve. So a lot of times we'll allow the owners, the owners will get into that kind of thing, but then we'll still have a self-directed sleeve, but it's going to go to Fidelity or Schwab, and they can get into stocks and bonds and things like that. So technically, here's what the rule is as an owner. Whatever you offer yourself, you have to offer your employees. So if you start diving into real estate, you technically have to offer this to your employees. Are they going to take advantage of it and do it? Most likely not. but it is something that you have to, it's in order to stay compliant, you have to offer it to them too.
Thanks. Let me put a little twist on that. Let's
Okay.
say I'm actively employed and I'm working for somebody and I've got a 401k,
Mm-hmm.
but I have 4 prior employers that I rolled into an IRA
Mm-hmm.
outside of my current employer, and that's got $1 million in it. Can I do anything with that?
100%. You can roll right into a self-directed IRA. You're just rolling those into the IRA. And I want to add a little path to this part of the conversation too here in a minute. But so you are absolutely allowed to roll previous and sometimes current assets into a self-directed IRA.
Okay.
And what I mean by that is there's distribution rules that, again, this is custom. We can turn on and off switches inside of your 401k however you want us to within regulation limits, of course. So for example, let's say you're over 59 and a half and you're allowed to do an in-service distribution while you're still working. Then you can roll your 401k that you currently have at your day job rolled into an IRA and start doing all these fun investment opportunities. If your plan is not designed to do that, then you are not allowed to turn that to roll that out. It's again boilerplate versus custom. So the other thing you can do is, let's say you have a day job and then you have a side hustle, right? Mowing grass, whatever it is, different consulting, right? That's covers a big amount of ground there. And yeah, so we use that. That's often used quite a bit. So you're allowed to double dip on your 401k, okay, to a certain degree. All right. So if your day job is architect, for example, or a lot of IT, we get a lot of IT people who have their day job and then they have their consulting business on the side that has nothing to do with IT or nothing to do with architecture. It's like they're a gardening consultant,
Sure.
Not even close, right? You can set up your own solo 401k and self-direct that. So let's go back to those 2 types of contributions you have, right? You have the $23,500, that's you as an employee of your own company, and then you have your employer, which is profit sharing. So you cannot double dip the 23.5. You can only hit that one time. You can have 10 401k plans, but you can only hit 23.5 total amongst all of them. Okay. But a lot of people, what they'll do is they'll say, I'm going to take advantage of my match at work, and then I'm going to do the rest of it in my solo 401k. Okay.
So you can have both. So if you're employed and have something on the side, I think what you're getting at is, yeah, you take all the 23.5 plus the employer match. But
Yes.
if you have a solo one, then you've got your own contribution, i.e. your profit sharing from whatever that other business is.
And you can double dip profit sharing. So
What
we'll
does that
have and let's say we'll have a highly paid W-2 person who IT, right? Is big. So they're getting a lot of profit sharing. They're getting a big match and they're maxing out their 401k. Let's say they are hitting that $70,000 because they have a very generous employer and they're making a ton of money at work, right? So their match just pulls it all the way up to 70,000. And if they have this side gig that has nothing to do with that job, they cannot be related in any way. They can open up their solo and max out another $70,000 on their solo 401k. So if they're making good money on their side gig and they're making 200 grand and 25% of 200 grand is 50,000, they can do another $50,000 because it's all profit sharing. You can't double dip the 23.5 because they're maxing it out at work at their day job. So that's all taken off the plate, but now it's all profit sharing. So it's technically a standalone profit sharing solo 401k and all of it can be double dipped. So now 70,000 plus 50, you just did $120,000 of contributions into your 401ks. 50 of it can be totally self-directed. And yes, you can get a mortgage inside of your 401k.
Wow. That's fascinating. It's also mind numbing. I mean, it's just, it goes, your brain goes off into, well, what's my scenario? What's someone else's scenario? How do I do this? I've been thinking about doing this. Do I set it up now? Do I set it up later? How much money do I have to make? Mm-hmm. Have you ever, I'm sure you have. So share a success story that's a favorite of yours. Someone who's turned kind of this basic 401k, not only into a tax saving machine, but they built wealth in an unexpected way.
Oh boy. I have a lot. a lot of really neat, fun case studies. So let's go with one of the current ones that we designed. And I'm going to use the split funded one. I'm going to go all the way to the top here. Okay. I'm going to go the highest strategy you can do.
Sure.
Doesn't mean everyone wants to do it. It just means this is what you can do. And I'm going to keep this in the solo world because solo is fun. When you don't have employees, it's fun. But because we know all of it goes to you. If you have employees, now it's talking about what's the efficiency rating, right? It's, are you in the black, you're in the red. If you're in the red, you don't do it. If you're in the black, you could do it all day long, right?
Yep.
So solo, husband, wife, they have basically it was the husband's job, and he made a good amount of money. He was a consultant and made some serious money in an industry that I didn't know existed. So what we did is we did the full stack, all three layers, 401k, profit sharing, and then we did a split funded defined benefit plan. He employed his wife into the company, and gave her a salary out of the total. So now when you do that, you now can basically double your contributions. And when you have a spouse inside of your 401k, it's still considered solo. It's a spousal solo. There's still no, it's very easy. You can duplicate basically all of it. Similar to a spousal IRA, which exists too, you're allowed to put money into your spouse's IRA, even if they don't have a job, basically, if they're a stay-at-home parent. So between the two of them, so we did the 401k, we did the profit sharing, defined benefit plan. Half of the defined benefit contributions went into a life insurance policy, and I'll explain what we're doing with that. When I say life insurance, I mean cash value, hefty life insurance policy. So between the two of them, when you add those up, we got them up to around $575,000 of contributions per year.
Wow.
Total. Every single year. Okay? Every year moving forward. And it
Pre-tax.
increases every year. Pre-tax, right? So that just saved them 40% of that, right? So, we're talking $250,000 of taxes that we just saved them. So what happens with the life insurance is we have a strategy on the back end is where you're able to buy out the policy on the back end. So you put all your money pre-tax in the policy, you buy it on the back end, it becomes voila, tax-free, which is life insurance is tax-free for the most part. And that's put into a trust that their kids and grandkids will benefit and created a multi-generational legacy.
Sure.
Into the future to where their kids and grandkids are going to be part of that equation with that trust.
That's pretty amazing. It's also pretty apparent that those two people combined made a lot of money.
Again,
to be able to do that.
It's not just doctors and lawyers anymore. These days, we have YouTubers, we have all sorts of different people that are clients of ours, and professional athletes too are out there. NFL players can do a lot of interesting things with this kind of stuff, but they have their pensions and they can do another pension with their advertising dollars and things like that. So it's interesting what you can do. It's again, this tax code is built. 401A is built for business owners. You just got to make sure that you take care of your employees too, and that's admirable.
I'll go back to a question that I had that you answered, but I want to get specific. How can someone know if their CPA or their plan administrator is leaving money on the table for them?
It's really hard. It's really difficult to know, I think, because there's, I mean, if you got a big tax bill, there's ways to bring it down. There's a lot of ways to bring it down. Now, this is kind of like going to, I look at myself as a quasi tax strategist in a lot of these things. I know enough to be annoying, enough to be dangerous, a lot of this stuff, but I'm not the one who implements a lot of the stuff that we talk about. We have other specialists that we refer to. And, if deductions on your home office doesn't get you there, hiring your kids is base level. Augusta rule is base level. Augusta rule is when you can rent out to your office, your home as a vacation rental or something to your business. And then, so those are lower level, smaller amounts. But then if you still have a 6-digit tax bill coming at you, there's a lot more that you can do. And I'd be happy to introduce anybody who needs to. We have a lot. We have tax attorneys, we have tax strategists, we have all sorts of different people. And this isn't firing your CPA by any stretch of the imagination. This is plugging them in as a specialist on top of the general practitioner is what that is. And they know that. They know that's part of the game. It's definitely not stepping on anybody's toes.
If you could look into the future today moving forward, what's the biggest upcoming change in retirement planning that business owners of all sizes need to prepare for right now?
I'd say state mandates. And that's not really affecting. The biggest change that we've had was Secure 2.0, I'd say. There's a lot of changes, but Secure 2.0 changed a lot. It gave you the tax credits, but it also changed the game on a lot of like deadlines and other rules and things like that. But state mandates are in the last administration, they were trying to do a federal mandate. They actually created something. I can't remember what it's called. It's where you can plug in basically the same, where you can add IRAs to your staff and it does payroll deduction. But the state mandates are coming. Again, there's a 15 or so now that are in place. So these are states like California, Illinois, Maryland, Colorado. There's a number of other ones that are in place. The most aggressive ones are going to be like Illinois, Maryland, California for sure. They just at end of 2025, if you have one employee, you have to have something in place. One, if you have one employee. A lot of the others are 5. Okay. And if you got a letter, don't ignore it for sure. But that's coming, and there's a total of 43 states that have something coming. They're voting on it. They've passed it. Something coming, and there's only 7. A few of the 7 that I can remember off the top of my head are Texas, Florida, Alabama, I think North and South Dakota, I believe New Hampshire, possibly. Those are some of the ones I can think of off the top of my head.
Yeah, you just listed those 5 states of the typical quote unquote U.S. tax haven states, or some of them.
Those are the ones. I don't think Tennessee's on there, but Tennessee's kind of like right in the middle there. But those are the ones that you expect to say no. I'm not going to mandate something. And then all the others have something coming. Ohio has, I think they're on their way, if not coming really soon. So there's a lot. So that's the biggest thing. And just so you have options, the default method is, I'll do it. And you just have to send the contributions. You don't match. It's free to the state. They have this bag of IRAs. Most of them are horrible, for mutual funds. There's 4 options. That's about it. Some of them are Vanguard funds, which are great, but like 2 have that in it, and that I can think of off the top of my head. But so you can do that. Like if you're in growth mode, you're like, I just don't want to deal with it. Let them do something. That's fine. Is there a better version? Yeah, those boilerplate online versions that you can think of, those are great for that. But if you actually want to use it, this is where, if you want to use the 401k for yourself, think outside the box. Like pause, don't go into the easy default option where your payroll service can say, I got this, it's BOGO season. You get this and you get this with it. Don't just go for that. Yes, it's easy, but it's 2025, almost 2026. Payroll integration is easy. You can get that set up with payroll integration. A lot of people, that's like the biggest green button to push. Is payroll integration is the number one goal and priority for my 401k plan. No, it should not be. It could be if you're in startup mode and you wear a lot of hats and you want to take a few things off, but there's ways to work around payroll integration, bring in third parties to do the integration for you and things like that. It's taxes. What's your net? What's your net? What's your net? Are you in the black? Are you in the red?
This has been great. You've thrown and I've thrown, we've both thrown, big numbers around, small numbers around. Yeah. so a bunch of different people and from all walks of life and all stages of life listen to the show or watch the show. Some of this I could see would be intimidating to someone with just, an IRA sitting there, or a 401k, even if it's got a big balance. Some people are doing the side hustle, extra gig, or their wife works or their husband works. And then all the way up to small business owners and medium business owners. So I guess, as we wrap here, what is your kind of typical financial or business ownership profile that, who's your typical client? So that's the first part. The second part of the question is, how can people find you and learn more about your work?
Yeah, we tend to work with folks who either want to have a little bit more control of their plan. So on the self-directed side, we have a very white glove self-directed option, like very neat software tool that we've partnered with a software company on building for them. So you can get into the crypto, you can get into the, you can go to any of these major custodians that we all know and open up a free solo 401k. It's not difficult, but you can't do anything with it. You're stuck with their protocol because this is the process they want. If they're not going to charge you for it, this is what you got. So if you want to have a little more control, we tend to get those folks quite a bit, where I want to get into the real estate, I want to get into crypto, I want to do stocks and bonds that I get to choose. And then I want to do all these other strategies around it, like the mega backdoor Roth conversion, which we didn't even talk about. How to get all 70 into the Roth. That's something that we didn't talk about. And then we'll get the ones who are really, truly wanting to build a team around them. They know what they do they're really good at what they do. They're a doctor, they're a lawyer, they're a YouTuber, all sorts of industries. What they do best, and they know that the value of their time is worth outsourcing it to someone who knows very much what they're doing and trusts their team. So we get a lot of people who want to build that team around them. We are one piece of that pie. And then we get those who understand that their profit is increasing and they don't want to have to switch from one model to the next model to the next and move it here and move it there. They just want to start where they can build it custom and start adding layers as their profit increases and have a team where they can get advice from. We're extremely consultative. We do year-end planning. You need to increase your salary by this much in order to get your contributions that you need. We will run those numbers all day long instead of you trying to guess it. So the DIYers, that's usually not who, and DIY investors we get, but the DIY who want to self-administer all this and figure it all himself, they tend to try to go out to the other turnkey shops, the boilerplate stuff, but we get those kind. But at the end of the day, I would advise anybody to just start asking questions. Because it's too big of a world, and the financial planners, the CPAs. I'm not dogging anybody here because what they do is they're fantastic. That's what they do best. But if you want to really dig deep into what is available at each one of those specialties, think of a bicycle wheel. Each one of those spokes is a specialist. You kind of got to do it on your own sometimes. You can ask them, say, hey, do you know somebody? I want to have a conversation. But if you do it yourself and do the research, our website is 401k.expert. Extremely easy to go get. It's a landing page where you can connect. Got some case studies on there. Someone on our team will have a conversation with you and just educate. We aren't salespeople. We are educators. So we just explain what is available, what the numbers might look like. We run numbers before you're a client because we don't want you to, we're not going to implement something and say, oops, sorry, you're in the red. It's going to cost you more than it's going to give you a benefit. We don't do that. If we need to run numbers ahead of time, we will run numbers ahead of time and say, hey, this is what it's going to look like. Give this to your CPA. And we love talking to your CPAs because it's a back and forth conversation for sure.
Now, this was awesome. Most, let's say, solopreneurs, side hustlers, business owners, small, medium, and large are out there building great companies and great revenue streams. And, from our conversation, I think most or many don't realize that their quote unquote retirement plan could be one of their most powerful wealth building tools. So thank you for the time today. If you want to learn more, I know you just said it, visit 401k.expert. where Matt's got resources, videos, and guides. I can show you how to build a smarter retirement plan that saves taxes and builds wealth. Matt, thanks again for joining me, and thanks everyone watching or listening for being part of this community, pursuing wealth, wisdom, and wellness in every stage of life.
Thanks, Matt.
Thanks for joining me on the Matt Ferret Show. If you enjoyed today's conversation, please share it with a friend and subscribe on Apple, Spotify, and YouTube. If you're on Apple or Spotify, a quick rating or review really helps more people discover the show. For more resources, visit themattferretshow.com and sign up for the Matt Ferret newsletter. And if you or someone you care for needs Medicare guidance, book a no-obligation consultation at brickhouseagency.com. Helping people make smarter choices as they age is my passion. This show is here to light the path towards your wealth, wisdom, and wellness. Thanks for being a part of the conversation.
The Matt Ferret Show, related content, publications, and MF Media LLC is in no way associated, endorsed, or authorized by any governmental agency, including the Social Security Administration, the Department of Health and Human Services, or the Centers for Medicare and Medicaid Services. The Matt Ferret Show is in no way associated with, authorized, approved, endorsed, nor in any way affiliated with any company, trademark names, or other marks mentioned or referenced in or on The Matt Ferret Show. Any such mention is for purpose of reference only. Any advice, generalized statistics, or opinions expressed are strictly those of the host and guests of The Matt Ferret Show. Although every effort has been made to ensure the contents of The Matt Ferret Show and related content are correct and complete, laws and regulations change quickly and often. The ideas and opinions expressed on The Matt Ferret Show aren't meant to replace the sage advice of healthcare, insurance, financial planning, accounting, or legal professionals. You are responsible for your financial decisions. It is your sole responsibility to independently evaluate the accuracy, correctness, or completeness of the content, services, and products of, and associated with, The Matt Ferret Show, MF Media LLC, and any related content or publications. The thoughts and opinions expressed on The Matt Ferret Show are those of the host and The Matt Ferret Show guests only, and are not the thoughts and opinions of any current or former employer of the host or guests of The Matt Ferret Show, nor is The Matt Ferret Show made by, on behalf of, or endorsed or approved by any current or former employer of the host or guests of The Matt Ferret Show.